Welcome back, investors, to Ticker Time News. I'm Adam, and here's the latest segment from the After Hours show. All right, another company that I want to dive deeper on is Splunk. Ticker symbol is SPLK. Let that load there for you so we're all on the same page. A mighty fall out of this nice trading channel that it was in. Now, Splunk is one we've talked about several times before because it was in this major downtrend. It had shot up to all-time record highs and then just fell off after miss on earnings, another miss on earnings, a soft earnings report, and another miss on earnings. Could this company turn it around? Well, maybe. It might be headed in that direction. Now, shares were up 4.6% today. So they did recover some of the loss yesterday, but yesterday they were down nearly 8%. So they've barely recaptured half of that so far. Now, with Splunk, I believe it is on the mend, as Q3 report shows that cloud transition, well, it's progressing. It's been an eventful month for big data company Splunk, which has seen its CEO unexpectedly resign and its stock price plunge by over 30%. Today, however, the gloominess has vanished, at least for the time being, following the company's Q3 22 earnings report. Although Splunk registered a loss for the seventh time in the past 8 quarters, its loss per share of 37 cents comfortably escaped analyst expectations by 16%. However, there is a key caveat regarding its bottom line outperformance. When Splunk announced that its CEO was stepping down on November 15th, it also issued updated guidance for Q3, forecasting revenue of $666 million versus the prior estimates of $643.3 million, with the current estimates only moving slightly higher to $664.5 million. It appears that some analysts didn't update their revenue models to account for the new guidance. We actually talked about this during the live stream when the news came out. The same holds true for EPS estimates, skewing the magnitude of upside for Q3. On the top line, Splunk did modestly exceed its outlook, generating revenue of $664.8 million, up 19% year over year. A key factor that's been plaguing the stock is that its revenue growth has plummeted as it executes its transition from a traditional software developer to a cloud-based one. We've seen this before with companies like Rackspace. I did a video on Rackspace maybe a month or so ago. They transitioned from being a software company to a company in the cloud, just like Splunk. Now, Rackspace, they've got their footing, they've turned it around. Maybe Splunk is starting to show signs that it's doing the same. In fact, Splunk posted 3 straight year-over-year revenue declines in Q2 21 through Q4 21, pushing it into the red after becoming a consistently profitable company. Although its growth ticked up a little bit lower, I should say not ticked up, but ticked down a little bit lower from last quarter's 23% mark. The general direction, though, looks positive, suggesting that the worst effects of its business model shift are in its rearview mirror. On a related note, cloud ARR. Now, I've said this phrase before, ARR, and I've gotten a few questions. What does ARR mean? Well, ARR means annual recurring revenue. So that's what the ARR stands for, annual recurring revenue. But for Splunk, their annual recurring revenue, or ARR, well, it surged by 75% year over year to $1.11 billion. And cloud accounted for a record 68% of total software bookings in Q3. In addition to some relief buying following the stock's nosedive, the momentum in Splunk's cloud business is catching investors' attention, just like with Rackspace. The main frustration for investors has been that Splunk's machine data processing capabilities are ideally suited to thrive during the digital transformation trend, but the company has struggled to fully capitalize on its favorable position. Now, with a more modernized pricing model that charges customers based on the volume of data processed, Splunk seems to be turning the corner. In fiscal year 23, the company is forecasting cloud ARR to reach at least $2 billion, representing an estimated year-over-year growth of 50%. Based on its fiscal year 2022 cloud ARR guidance of 1.3 to $1.33 billion. This growth is coming at a cost as the company builds out its ET phone home, right? IT, as it builds out its IT infrastructure to ramp up its cloud hosting capabilities. For fiscal year 2022, Splunk is anticipating non-GAAP operating margin to decline to between 17% and 15% from 4% in the year earlier period. Overall, it remains a mixed picture for Splunk, but the steep sell-off in the stock ahead of its earnings report was overdone, in my view at least. The company still has plenty of work to do, so don't get me wrong on that one. Its turnaround is not complete yet, and its financials are far from pristine. However, the strong cloud ARR growth, bolstered by an increasing number of large contract wins, is an encouraging development for the bell-guarded stock. All right, so that's my thoughts on Splunk. What do you think about Splunk and its transformation? Do you think that it is finally turning the page, or do you think there's still a lot of work ahead to make this transition for Splunk? Let me know in the comments. I'd love to hear from you. Thank you for watching this segment from the After Hours show. If you want to watch it live, then join me on this channel every day the market is open around 5 p.m. for the latest stock market news, deep dives on your favorite ticker symbols, and most importantly, answer your questions. Make sure to click the like button and share this video with others so we can all reach financial freedom. Thank you so very much for watching, and I will see you in the next video.